Welcome everyone to another episode of Record Time. It's good to have you back. Today we're covering an important topic around sources of finance, and hopefully this is a good foundation for you as we go on and we cover topics like cost of capital and capital structure. So really pay attention here, and hopefully by the end of this, you will now understand the different forms of finance that are available to an entity. Remember, in finance, you've got different decisions. You've got the investment decision, and you've got the finance and the dividend decision. So the financing decision is supporting the investment decision. It says, I found an investment, but how should I finance that investment or those operations? That's the question that we're going to be answering today. Okay, so let's first talk about financial markets. Financial markets are a key barometer in terms of how we determine different sources of financing. There's just some terminology that's worth exploring that you should know. First of all, the difference between money and capital markets. You'll hear a lot of this in finance. So what's the difference? So a money market is mainly used by businesses for short-term funding, right? So any funding that's less than 3 years, predominantly for liquidity and working capital purposes, then a company would go into the money market to raise funds. So many commercial banks and various financial institutions do offer money market offerings where it's usually, for example, 90-day bills, or it could be, highly liquid money market accounts that have maturities that are less than, 3 years for that short-term funding that you require for liquidity and working capital purposes, right? The opposite of money market is capital markets. Capital markets are generally what businesses use if they want to raise long-term funding. When we talk about long-term funding, we talk about funding where the debt is a tenure of more than 3 years. So this is primarily if an entity is looking to expand or grow its business or fund an acquisition of some sort, really trying to grow for the long term. Examples of capital markets would be the Johannesburg Stock Exchange, JSE, where you could list your shares and therefore fund for the long term. Again, you could also, many of the commercial banks would provide loan funding where the tenure of those loans are higher than 3 years, would be an example of capital markets there. Okay, the next important element of financial markets is understanding the difference between primary and secondary markets. And you will understand that there's a nuance, especially when it comes to raising funding. First of all, primary markets, this is the where market makers generally play. So when we talk about a market maker, this is when you either issue new securities or issue new bonds or issue new loan funding. So any instance of new securities being issued, right? And we use the term securities broadly. We'll talk about the different types of securities later, from debt to equity securities. But if you are listing new securities on an exchange or anywhere, we call that the primary market. And an example here is an IPO. IPO stands for initial public offering. So when a company moves from being private to being a public entity, usually it'll start listing its shares and advertise them to the public via initial public offering. The secondary market has to do with the buying and selling of existing securities. This is where securities that have already been listed via an IPO are then bought and sold between investors. So, for example, if you were to go to Easy Equities or any of the investment platforms and decide to buy shares, for example, in MTN or APSA, that would be an example of you going into the secondary market. Now, companies do not raise funding from the secondary market. That's very important. They have no control over what happens in the secondary market. In the secondary market, your retail and maybe your institutional investors are buying and selling on a daily basis, trading, but those cash flows do not go to the company. So therefore, we know that it's only in primary markets where entities are able to raise funding for their businesses. The next distinction about financial markets is the degree to which they are formalized, right? You could get formal and then you get OTC market. So formal markets are those markets that are regulated on some type of exchange. For example, the Johannesburg Stock Exchange, this is where entities can list their equity securities. They are highly regulated with different rules and prescriptions of how entities should basically interact in that market. And those are what we call formal exchanges. In America, for example, we've got the S&P 500, the NASDAQ. You go on and you in Europe, the FTSE, the London Stock Exchange, all of these are examples um, of regulated exchanges. Now, OTC stands for over the counter. Now, over the counter means these are bilateral arrangements between counterparties that tend to be informal, flexible, and bilateral. That's what we're saying. And typically, these arrangements are between banks or forex trades. So, banks are typically the entities that are big players in OTC markets. And you'll find that most of the time in OTC markets, this is where entities go for risk management purposes, which we'll talk about, which is one of the key sort of like reasons why entities may go into financial markets. But really, understanding here that instruments that are not on a regulated exchange will typically be over the counter OTC. Right. Then we talk about the spot and the derivative markets. So what's the difference between the two? The spot is where we get immediate settlement. So for example, you could have for Forex treatment, you could have the spot market where you buy and sell currencies at a particular point in time. You could also, for equities, you could go to the spot market where you can buy equities immediately and it's settled. Um, but then you also get derivatives. Now, derivatives are those that are traded over the counter typically, but sometimes they could also be on an exchange, right, guys? But ultimately, yeah, the contract is based on an underlying asset, right? So really, an option and futures, these are examples of derivatives. Again, guys, this will be covered in later topics when we look at financial engineering. For now, understand that derivatives, which are basically contracts that whose value is dependent on some type of underlying. For example, if you have an option, you have a right to buy stock. So therefore, the option value is based on the value of that stock you have a right to buy or a right to sell if it's a put option. Futures is basically a contract to buy a specified asset in the future. Again, it's listed on exchange, but its value is driven by that underlying asset. That's the key here for derivatives. Okay, let's talk about one of the most formalized components of financial market within the South African context, which is the Johannesburg Stock Exchange, right? So the Johannesburg Stock Exchange was founded in 1887, and it is growing to include a variety of different markets, equity markets. In the secondary market, we know that entities may do initial public offerings to raise funding via equity, but it also it's a big player in terms of secondary markets where institutional and retail, but guys, when we say institutional, we mean large investors, right? Like investment firms, insurance companies, those are what we call institutional, but retail investors are you and me, everyday people, right? So all of these people would be in the secondary equities market as well, buying and selling shares. Then the derivatives markets, we've already spoken about this, which is, for example, SAFEX. Derivatives are also listed on the Johannesburg Exchange. For example, these could be warrants, options, which are there. So basically, a warrant is basically a listed version of an option. And then you also get a listed version of a forward contract that we call futures. So futures, warrants, all of these would be sitting on the derivatives market. Then you also get the debt market, right? Formerly known as DESA. This is where, for example, corporate entities might want to raise funding via debt instruments. And then they would issue things like bonds or, or what we call debentures on these exchanges in order to raise funding. So there's been key developments that have happened from 1996, which is JET, the inclusion of JET, and then you got straight. Straight basically spoke about rules around settlement, when and who can settlement in what way, just to enhance the liquidity of the market. And you'll find that in Africa, just out of interest, the JSE is one of the most liquid markets, one of the most sophisticated equity markets in Africa. So the introduction of straight was key to be able to achieve that. And electronic trading, you'll be amazed that in some African jurisdictions, they still have manual trading where before you buy stock, you have to call a counterparty and see if there's another person on the sell side for you to buy. Literally, this is still happening, guys. So the JSE has electronic trading, which was very key towards 2002. So the benefits of listing, why would entities want to list on the JSE? It's access to capital, right? As we've mentioned, you can do an initial public offering, and depending on the sentiment around those shares, you could raise massive amounts of money through that process. An increased profile. We know that companies that are listed tend to have prestige, respected in the market. This could have a secondary effects in terms of customers and people who support you. So sometimes it can be an important element there. Liquidity, right? To enhance the liquidity of your securities so that investors can buy and sell quickly, is also some of the benefits. What are some of the challenges? With all good things, there must be some disadvantages. It's compliance, right? Remember, we mentioned that formal markets like the JSE are highly regulated. So come with this regulation in terms of who needs to audit you, what financials, and when you have to prepare them, and certain disclosures could have a high compliance element to it, which could be onerous for a business. Secondly, the cost element, it costs money in order to comply with all these requirements. You have to enlist the services of experts, auditors, lawyers, and all these people that can cost the business money. Disclosure, right? Sometimes because you are now um, listed in the JSE, certain confidential information or information that might be able to give you an advantage. Now you have to disclose because now you have to be transparent because you're a publicly listed entity, right? Market pressure, right? We've seen instances where CEOs have been fired in these top companies because the stock price is tanking, right? Case in point, Steinhoff, we saw how the stock market tanked there and all hell broke loose. And that's exactly that type of pressure that then comes when you're listed on the exchange, which is a challenge. Um, on the JSE, we've got what we call the main board and the Alt X. So the main board is for your more established entities, whereas your Alt X is for your high growth SMEs. If you can look at the difference to list on the main board, for example, you have to have share capital above 25 million, whereas Alt X it's 2 million and above. So therefore, there's a lower threshold. The public shareholders on the main board is 300, whereas Alt X is 100. Profit history over the 3 years, you must have a pre-tax profit that's greater than 8 million, whereas on the Alt X, none required. So your target company, so the main board is mainly for your established entities that have been there for a while, tried and tested business models. Whereas your high growth SMEs would be on your Altex, right? The key support here, you need a sponsor to list on the main board, whereas an Altex is a designated advisor. Some of the nuances. Something that's also new that's come up now is what we call the ATX exchange. Um, what the ATX is, it's simply an alternative place to transact in securities. So currently, companies will not be able to raise capital on the ATX because it's not able to accommodate initial public offerings, right? It doesn't accommodate IPOs. However, this is expected to change in the future, so watch out for the ATX. Perhaps at some stage it will allow initial public offerings. The use of advanced exchange technology has resulted in lower transaction costs. I think that's the key here. It was launched in 2017 for secondary listings. So it's not for primary listings. So therefore you can't raise funding here. So very important. But because of the fact that it has advanced exchange technology involved, it's really resulted in a reduction of transaction costs, right? Over 50% reduction in fees, which also narrow bid and offer spreads. So what bid and offer spreads are, this is typically what the dealers or the money or the market makers make on offerings or listings on the JSE. So by narrowing those bid offer spreads, you're lowering your transaction costs. There's also improved liquidity that's associated with this. So it's very disruptive. So watch out for this. Which will with this offering A2X exchange, which will be lower fees, no listing costs. It won't allow you to raise capital, but it will certainly provide the liquidity and the prestige that is required around being listed. Okay. So let's talk about the methods of obtaining a listing, right? In terms of from an equity side. The first one is what we call when you have no new capital. No new capital, you just mainly meet the JSE requirements. That's an example there of a listing. Another one could be private placing. So private placing is when shares are sold to institutions via roadshows. You'll see sometimes companies go around and basically market um, their offering and what the business is about via roadshow. And then through this roadshow, they are able then to get commitments from your different investors about the prospects of where the business is going, and then get and privately then place um, offers to be able to subscribe for the shares. Right, it's very strategic and has been used as a way for listings. So public offering, we've already spoken about it. The initial public offering, this is where the shares of the entity are offered to the public as an offer, or or an existing for sale, or sometimes existing shareholders will sell their shares to the public, and the proceeds go to the current shareholders. So, for example, in an offer for subscription, the company invites the public to subscribe for shares that have not yet been issued. That's the offer for subscription, and the proceeds go directly to the company to finance its operations and investment opportunities. Um, Widely known as an IPO. You'll find that usually the company will be required to produce a pre-listing statement or a prospectus, and based on that prospectus, then investors can then bid and be able to be allocated shares to fund this expansion in the business. Another one is what we call backdoor listing. Now, backdoor listing, it's basically the company obtains a listing indirectly by using an existing listed company to achieve a listing. So this is often undertaken by using a cash company. For example, we call this cash company cash sell or cash shell. This is the entity which is listed on the JSE, and the only asset is cash as the company has sold off its other assets. So it's a bit weird. So you've got this cash shell entity listed. The only asset is cash, and other assets have been sold up. And there are basically two alternative ways of achieving this. So you either by selling the company's business to the cash shell in exchange for shares, by arranging that the shell company takes over the operating company and is required to issue so many shares that its current shareholders lose control and the new shareholders acquire control of the listed company. Right? This is what we call a reverse takeover. Again, we'll come back when it comes to mergers and acquisitions. Don't need to know this, but for now, just understand that you could have reverse takeovers where the shell entity buys the operating assets of the operating entity, and essentially now you've got these shareholders losing control and the new shareholders acquiring control of the listed company. And in a, what we call a reverse takeover. Um, cool. Let's talk about raising capital as a listed company. So how could you go about doing this? Um, there are a number of ways. The common one is what we call a rights issue. So a rights issue is basically where you offer current shareholders a discounted new shares. So effectively what you're saying all these shareholders currently have shares in the company. We're now going to try to raise funding via equity in this business, and we're going to do a rights issue where we allocate shares proportionally under some type of proportion to existing shareholders at a discount in order to raise funding. So, for example, if we have a 1-for-9 rights issue, this means that for every 9 shares that a business has, I'm going to issue one additional share, right? This could be the case, for example, where let's say a company has 90 million shares it has issued and it needs to raise 50 million for expansion purposes in the business. Let's say the subscription price at 5 Rand per share, and let's say that the current shares of 90 million are trading at 6 million at 6 Rand per share. So you could have a theoretical value of 5 Rand 90. And what that 5 Rand 90 would be it would basically be a combination. It would basically be a combination of basically the 6 rand. If you take the 6 rand and you then multiply the six, right, by the 90 million shares, right? If you do that, I think if I'm not mistaken, let's quickly do that. Six times 90. I think you get 540 million. So this is the share capital at the moment, 540 million, right? Basically six times 90 million. So 90 million shares at 6 rand, 540 million. And then what you also get is um for every one share. So if you think about it, we're basically saying the ratio of the rights issue is 1/9, right? So for every for every nine existing shares that a business has, they're going to get one additional share. So if you're going to say 1/9, and then you multiply this by 10 million. Why are we multiplying this by 10 million, guys? Well, remember the company wants to raise 50 million worth of funding for its operations, and the subscription price is 5 rand per share. So if you take 50 million divided by five, you get 10 million. So it essentially is going to issue 10 million shares. So of those 10 million shares that are currently in issue, each shareholder is going to get one share for every nine share it holds. There's the ratio, 1/9. So therefore, if you do that and then you multiply this, right, by 5 rand, you're going to get the new equity value of these additional shares, right? So essentially, 10 million shares, one divided by nine, basically, um, times 10. So each shareholder is going to get 1.11 additional new share, basically. And then you multiply it by five, it's you get a price of like 5 rand, 550 per share. So it's sort of like 10 um 10 million. So you're gonna get like 5.5. So essentially, or another way you could have done it is basically say, okay, you've got 540 here, and then you've got 10 million, you've got 50 million, sorry, 50 million. Um, then take the 540 plus 50 million, 590, right? I think this is a more complex one. So the 540 is the existing shares. The 50 million is basically 10 times 5. So the total here would be 590. And then if you take the 590 and you divide the 590 by the total shares in issue, in this case, it will be 100 million. Why is it 100 million, guys? You've got the existing 90 million and the new 10 million. That's how you get the theoretical value of 5 Rand 90 per share, right? And then, so 5 Rand 9, so an existing shareholder basically would basically for every one share or for every nine shares that they hold, they're going to get an additional one share. So effectively, um, that's what they're going to do. So they're going to work out. So an investor, who, let's say, for example, has 100 shares, how much will the right issue cost for them? It will be 1/9, right? That's the ratio times 100 shares because they have 100 shares, right? And then multiplied by 5 Rand 90, essentially. Or times five, sorry, because it costs 5 Rand per share. The 5 Rand 90 is more of a theoretical value, weighted value. So one divided by nine multiplied by 100. So meaning that that existing investor had 100 shares, but based on the proportion of 1:9, they're going to get 11.11 new shares, and then a price of five. Then the rights issue is going to cost them 55 Rand in total, 0.55. So very important to be able to do these calculations, guys. Yeah, just play around with these calculations. Think this is not important. This is confusing. So just to summarize again, um, so an investor had 100 shares. but the ratio of the rights issue is that you get one share for every nine shares. So it's 1/9 times 100 and then multiplied by 5. That's how we got 55.55 shares. Cool. I mean 55.55 Rand that will cost them in relation to the rights issue. Okay. Another way, important consideration, especially for this, is liquidity, right? So by raising capital via listages, it offers this liquidity, right? What's common is that the top 40 firms usually dominate activity, but again, as you've mentioned, it's a good way to be able to raise funding. Okay, let's look at the JSE derivatives and debt markets. Remember, spoke about this in terms of financial markets. What's the difference? Why would a company go to the derivatives market and the debt market on the JSE? So the derivative markets that we call SAFEX, usually it has, from a financial perspective, you could have equity index futures or options. From agricultural, you could have maize and wheat products, wheat contracts. And then the purpose here of going into the derivatives market would be for risk management and speculation. So, for example, an example of this, let's say if you have a farmer, or let's even if you're not a farmer, let's say you're a retailer who uses maize, for example, in your production. Let's say you're a manufacturer or a producer. So, a producer of maize meal. You are a producer of maize meal, and one of your significant inputs in the production process is maize, and you know that the price of maize is dependent on market conditions. So you then could go to the derivatives markets to manage the price to say, in instances where the maize price might be too much, I'm able to then buy a future that locks in the maize price at a certain future date when I need it in my production process in order to manage my cost. So there it's for risk management. There I'm managing the price risk, which is the risk that that maize may become too expensive. Another one could be, and I think we covered it in the previous section when you talk about risk, currency management, where let's say you're going to buy a new machine in Japan and you're worried because it's a foreign transaction. If you guys remember from our previous class, is that you're purchasing there in a foreign denominated currency, so there's transaction risk. You're worried that the rand will depreciate in value against the yen, which means that that contract will be more expensive to fulfill using your rands. So where, for example, the exchange rate was 1 rand equals 10 yen, right? Then you'll find that maybe in a year's time, 1 rand basically equals less yen, like five yen. So that means your local rand or local currency has depreciated, so the rand is less valuable. So in a contract that costs, for example, 100 yen could have cost you maybe 10 rand a year ago. Now all of a sudden, because the exchange rate has become less favorable by a factor of like say 100%, that contract now costs you 200 rand because the rand is weakened against the yen. So that's why you then enter into a future, maybe a currency future in the derivatives markets to lock in the exchange rate at 1 rand equals 10 yen, so that even if the rand depreciates to 1 rand equals 5 yen in the future, you're still protected against that strengthening of the yen against the rand. Cool. And another element is speculation. Some business just go basically to earn a quick profit. You go to the forex market, and banks do this all the time, where they simply, because they know if they enter into a large volume, let's say of forex transactions, they then speculate on currency to earn a quick buck, and then take that money to basically deploy in other areas of their business. Why would someone go to the debt market, formerly known as Visa? So so bonds. So examples of bonds. Bonds, guys, tend to be instruments where initially, right, there is a capital raise where there's a face value. So investors will usually contribute money up front in the form, and then they'll usually periodically, either monthly, quarterly, or annually, receive what is called A coupon is basically a return or interest. It's a form of interest that you get periodically. And then at the end, at maturity of those bonds, so bonds could be having tenures of 2, 3, or 5 years. And typically, the longer the tenure, because of time value, the higher your coupon payments or your yield that you get on your bond to compensate you for that risk you're taking over a longer time. And therefore, then as an investor, you get your capital back at maturity, but throughout the period, you get these coupon payments, which is basically your return on invested capital. So this is a common thing that bank businesses can use, or corporates, where they can issue government bonds on the JSE, like government issuing government bonds, or even corporate bonds. So if you're a corporate, it's called a corporate bond. If you're the government trying to fund expenditure, you list it on the JSE, or a repurchase agreement, or what we call a repo market. All of these are designed to raise funding for institutions, businesses, or the repo market is more the South African Reserve Bank. Those are the people who would raise funding via or try to control or conduct monetary policy via the JSE. Corporate bonds are for businesses or corporates, and then government bonds for governments. So you get different types of bond types. Fixed, these pay a fixed coupon. So every month, quarter, or year, you get a fixed amount. You could have a floating. These could maybe fluctuate based on a JIBOR rate or prime, whatever it is, and that's usually it will be JIBOR. That's typically there. JIBOR meaning the Johannesburg Interbank exchange rate. Um, or you could have zero coupon bonds where they don't pay a coupon, but at the end they return your capital. Commonly used here. You could have inflation-linked bonds. Again, trying to protect the investor against inflation impact. So a key issue is in the market are your government. If, for example, government wants to raise funding to conduct fiscal policy or expansionary policy for the state, they could raise capital there. Parastatals like ESCOM, for example, corporates in turn and CECL if they want to fund expansion. Financial institutions, this is another key area where funding can be raised. So your commercial banks, we know that in a South African context, what ABSA, Standard Bank, First Rand, RMB, Investec, all these banks, where you could, as a business, go in, get an overdraft, a loan, or a foreign exchange, right? Key areas. Investment banks also provide corporate finance, private placement. Again, the large commercial banks will have investment bank opportunities where you can raise corporate finance, private placements, and listings that we talked about. Insurance and pension funds is also another key driver of raising funding. If you think about insurance companies, the premiums that they collect in relation to their policies, they can then take that money and invest in assets that can generate a return. And that's why it's a key tool as well to raise funding from the market. Pension funds, believe it or not, as and when you work, your retirement fund entities take your money and they invest it either in the stock market, debt market, private equity, and try to generate a sufficient amount of return that can help you live comfortably when you retire. So again, they too can be a key tool. Pension funds can be a key tool to be able to raise funding. Now, let's talk about private equity and venture capital, which is a new and growing space where businesses can also raise funding for their different elements. So, private equity has to do with the buyouts, restructures, growth, investments. So, typically, companies that are looking to raise funding may do so via private equity. The key thing about private equity is that what tends to be the idea here is that businesses will get a cash injection in exchange for selling equity stake. Let's say, for example, you raise funding in exchange, you give 20% of your business away. And usually the private equity firms will come into the business and then they'll provide advisory and other services in order to make the business more profitable and to be able to achieve its objectives so that they too can can basically earn their return. So it's a good and growing market where businesses are raising funding. Venture capital is a form of private equity, but this one is more for early stage or high risk startups, right? These startups haven't had, for example, traction or haven't had proof of concept yet, but maybe the idea is one of novelty or a good idea that requires funding in order to be able to accelerate. And that's where venture capital can come in these exciting sort of high risk as the early stage type of investment. When no one wants to come in, where banks don't want to give you loan, where private equity firms also see too much risk, that's where venture capitalists will come in. Usually, whether you're in private equity or venture capital, the exit is usually when you do an IPO. So private equity investors, they'll come in, let's say at a X amount of rate, then they'll help management grow the business. And once the business is big enough and established, it will then be listed on the JSE. And then once IPO happens, they then exit. Another way to exit is trade sale by selling the shares at a later stage or executing a buyback where the business becomes large enough where now it can buy back its shares from the private equity or venture capital. Yeah, this is just a screen. Usually, these private equity firms, venture capital firms, usually look at an internal rate of return of what you call money market, money weighted returns of between 20 to 30%. But on average, what is actually materialized is that returns are actually closer to 11.6. So you can see that there's been this push for private equity, but it hasn't really generated that return that investors would have wanted. Okay, cool. Let's look at some special institutions. I'm not going to go deeper into this, so you can read up on this in your spare time. So these are some development institutions in South Africa where businesses can also raise funding. For example, IDC, the Industrial Development Corporation. Usually, if you're doing some type of industrial development, BE, where something is associated with job creation, you can raise funding here. So, Public Investment Corporation, which is Africa's largest sort of investment holding firm. Usually, they deal with government pension investments, BE, and impact deals. Again, another key way you can raise funding. The National Empowerment Fund, again, B empowerment and public equity transactions, they're very keen in those things. SIFA, which is the small SIFA, which is basically for your micro and SME lending. Again, providing that sort of debt funding for these small SMEs. Then you could have business partners who could grant SME equity loans and mentoring. Okay, cool. So let's look at equity related instruments, which is another a core tool in terms of raising funding. So what do we mean by equity related instruments? We're talking about ordinary shares. So ordinary shares are shares that basically give you part ownership in a business. Usually they are associated with a higher risk because of the fact that in a liquidation setting, usually the people who would be paid first are your debt holders. And then after your debt holders are paid, then your preference shareholders will be paid. And only after the preference shareholders are paid, then you, who's an ordinary shareholder, will will be paid. So because you are the last person to be paid in a worst case scenario, if if the business becomes bankrupt, there tends to be higher risk. But also because there's higher risk, there's going to be higher return. Remember, we spoke about it in the previous videos that there's a relationship between risk and return. Typically, the higher the risk, one would expect a higher return. The lower the risk, the lower the return. And then, of course, the benefits of ordinary shares that they give you part ownership in the business, and then you can vote around the strategic direction of where the business has to go. Preference shares, I like to think about preference shares as sort of like the middle ground where and so preference shares could either be debt instruments or equity instruments. So here we're talking about preference shares that are equity instruments. The key distinguishing feature well, on whether preference shares are equity or debt would be whether they're redeemable or not. So redeemable preference shares meaning they give you preference over ordinary. So that's why they're called preference shares. They give you preference in a liquidation setting. you will get your return before ordinary shareholders. So that's where the preference element of the shares comes in. However, of course, there will be a lower return, obviously, on preference shares compared to ordinary shares because there's a lower risk. But also, preference shares will rank lower compared to debt holders. So they would have to wait for debt holders. So therefore, the risk is higher on a preference share than it is on a debt instrument. Cool. So very important there to note. So you get different types of preference shares, right? The one is accumulative. So accumulative, so assuming that it's non-redeemable. So these type of preference shares would be assumed to be non-redeemable, meaning there's no requirement for the company to pay back the initial amounts that they've received from the investor. Whereas if it's redeemable, that initial amount invested by the investor has to be returned at the end or at maturity, whether I prefer is at 5 years or 6 years, whatever the terms are. So a cumulative non-redeemable preference shares would be one where the investor, where the company receiving funding is not required to return the funding. However, the investment may accumulate cumulative. So cumulative meaning periodically what preference shares will entitle an investor is basically dividends or and therefore these dividends that is paid either monthly, quarterly, or annually will accumulate until they're actually paid, right? So another form of preference shares is non-redeemable participation shares. This is where again investors is not entitled to an amount at maturity. However, they can participate in the share in profits beyond the fixed dividend. So you get your fixed dividend periodically. In addition, you can share in profits of the entity. So therefore, getting a bit of exposure that ordinary shareholders would get. Then you get convertible preference shares. So these would be non-redeemable convertible preference shares, where you still get the fixed dividend, no requirement to pay the initial capital invested at maturity. However, there may be a conversion option where at a specific point in time or once a specific target is reached or time period is reached, the investor can convert the preference shares into ordinary shares. So these are what we call convertible shares. Then, of course, redeemable shares. We know that these are quotable after a period. So redeemable shares, guys, very important. These are debt instruments, right? I know that we've included them here, but it's worth highlighting that these would be this potential, if it's non-redeemable, potential equity, potential equity. But here, this is definitely debt. So whenever your preference shares are redeemable, that's what you mean, meaning they have to be paid back after a period, that initial invested capital, then it's a debt instrument. It's no longer an equity related instrument. Full retained earnings is another form of equity funding. And usually, guys, according to the pecking order theory, which we'll cover in capital structure, retained earnings is generally the cheapest form of equity finance. It's cheaper than issuing ordinary shares. The issue with shares is that if you want to list, there's usually going to be issue costs associated, right? Whereas with retained earnings, you're funding your business using the profits that have been accumulated over time. So usually it will be less costly compared to ordinary equity. But again, it's still a form of equity funding. Cool. Let's look at debt instruments. So when you talk about debt instruments, these are instruments where the initial capital amount is repayable to the investor at a later stage. So common one, we've already spoke about corporate bonds, which is basically you invest upfront. Usually that's how bonds work, guys. Let's say you're an investor. You usually, let's say you've got 100 Rand. If you buy a bond, let's say the bond has a 10-year, 5-year bond. So this means that in 5 years' time, if from an investor perspective, that 100 Rand will come back to you, right? So that initially you invest 100 Rand and then that 100 Rand comes back to you. But over the 5-year period, over this time where the money has been given to the entity, this entity has to pay back what is called coupons. So coupons have to be paid periodically. So basically, as an investor, maybe the coupon is 5 Rand per annum. So as an investor, you get your 100 Rand, right? And maybe you get coupon of 5 plus 50 Rand. basically. So you get the 50 Rand would be, assuming that you get a coupon of 10 Rand a year. So if you take 10 times 5, so overall as an investor, you get your 100 Rand back plus the 50 Rand coupon, which is your investment. That's how bonds work. Debentures are essentially similar as well to bonds. Initial capital amount, and then on maturity, you pay back um, principal. Okay, cool. Bank loans, right? Everyone knows what a loan is. So essentially, a loan, again, you get an amount upfront as a business, but then you have to pay interest periodically, as well as capital, right? So there are different types of bank loans. You could have term loans, for example, which are for a defined period. You can bullet loans. A bullet loan would work similar to a bond, where you pay interest either monthly, quarterly, or annually. Then at the end, that initial capital that you got, you have to repay it in full. Other loans could be amortizing. We haven't included yet, so let's include amort. So just amort. My handwriting is a bit weak. So amortizing. Uh, it's so an amortizing loan. In an amortizing loan, basically you pay both interest and capital. So an example of an amortizing loan would be a mortgage on your house, usually, or maybe a car funding arrangement. Every period you're paying both interest and capital to the bank. Um, then of course I've included mortgage loans here. You get what we call secured by property, another type of debt instrument, which is an amortizing loan. I think they've included it here, so that's fine. An unsecured note. An unsecured note is where there's no security. So unlike a mortgage loan, which is secured over property, if you default there, then the bank can take back the property. So therefore, you'd find mortgage bonds will tend to have a lower interest rate because there's lower risk for the bank. Whereas an unsecured note would have higher risk, right? So in therefore, because there's no asset, if you don't pay back the note, and then essentially there's no assets to call upon to get the capital. So higher risk, but often what you find is that it's going to be subordinated. So subordination basically means that it will be ranked um, lower than certain other instruments, right? So when you subordinate a debt, it means that it's viewed as being lesser than a specific debt. So subordinated debt is so in a liquidity or liquidation setting, you usually settle your senior debtors first, and then maybe you get subordinated or junior lending. So in some arrangements, it could be that when you say, and I guess when you say subordinate the loan, it could mean that this loan would be viewed as a senior priority loan with other debt. So, for example, an unsecured note, because of the higher risk, the bank could demand that if the company has other debts, those debts must be subordinated, meaning those, so this note must be viewed as a senior note. So in a liquidation setting, if I've subordinated my other loans, this means they will be ranking lower than the note. So any cash that's available in a liquidation setting in the business will be used to pay the unsecured note first before the subordinated loans are paid. Cool. Then you obviously get high foreign loans. So this is where you borrow in a foreign currency. Typically, you'd want to enter into foreign loan if you have a foreign investment to have that natural hedge that we've talked about. Cool. Another element could be hybrid instruments. Hybrid instruments are basically instruments that have elements of both debt and equity at the same time. That's what we saw convertible debentures. So if you have a debenture, for example, that pays, let's say, periodically a coupon payment, but at the end, at maturity, gives the investor the option to convert the payment due into equity shares, right? That's an example of a convertible. So there could be various tax treatments. So usually I think there's section 8E and F from an income tax perspective. So you have to be careful with convertible debt. For example, if you are the issuer of convertible debt, in some instances, you may be prevented from being able to deduct, if, for example, it's viewed as this hybrid instrument, you may not be able to deduct the payments that you make. Whereas if it was a loan, you would have got an easier deduction and a 24J. So there are tax considerations that underpin hybrid instruments. Again, not the purpose of this section, but whenever you say hybrid instrument, though, you must also question whether or not there's sufficient tax deductibility of the instrument. Control, of course, because there's an equity feature, there's a likelihood that control may be impacted when it's exercised. Right. So let's now compare the difference between debt and equity. Again, in tests and exams, this is an important question because you will find that they'll ask you, should the entity raise debt or should they raise equity? How do you make the difference? The first one is cost, right? Usually debt funding tends to be cheaper. It's cheaper because it's tax deductible. Usually you get a deduction. We know that under Section 24J, which you guys would have covered in your tax classes. So where you pay an interest of 10 Rand, if you multiply that by 27, your effective tax is basically um, 73% basically of the 10, which is 7 Rand and 30. So instead of paying 10, you're only going to pay 7 Rand 3 because the difference of 2.7 there on that 10 Rand will be a tax deduction, which is money coming to you, right? So debt instruments tends to be lower because of tax deductibility. Also because debt funding tends to be lower risk. Again, remember in a liquidation setting, the debt holders will be paid first before your preference shareholders and your equity shareholders. So therefore, because of this lower risk, it will be less or inexpensive or cheaper compared to equity. Equity, on the other hand, is not deductible typically. So there's a cost associated with not being able to deduct tax. And also, because it's higher risk, there might be investors will require higher return, right? Because we know that there's no requirement for a business to pay back equity funding or to declare dividends. So therefore, investors would be requiring a higher return to compensate them, and that will result in a higher cost for a business because if you're going to issue shares and investors want a higher return, that means it's going to be more expensive to raise that funding. Risk, we spoke about it. Of course, debt instruments can exhibit a bit of risk because of the payments are fixed, meaning you cannot avoid them. Because you cannot avoid them, there's risk attached. And of course, the more leveraged you are as a company, or then the higher the risks that you perceive. From a business side, the equity could be viewed as a lower, but only here we're looking for cash flow. So I think here it's very important that when we say risk, we're not saying general risk. Um, the risk we're talking about here is the risk associated with cash flow. So cash. So I think maybe I would want to change risk and maybe focus on cash risk, right? But overall, debt instruments are less riskier for a business compared to equity. Or investors, they are less riskier to investors than equity. But from a business perspective, right, obviously there's more cash risk in debt than equity because of the fact that there are higher payments for debt, which are usually fixed, that can't be avoided. Whereas for equity, you tend to have lower and optional payments, meaning you only pay if the business is profitable. If the business is not profitable, you don't pay anything to investors. Control. So usually debt instruments don't give you any voting rights, which is also good for businesses because they can control the strategic direction of the business because there's no voting rights associated with debt instruments, so there's no loss of control. Okay. Whereas from an equity perspective, when you issue shares to raise funding, there are voting rights that are typically attached to those shares, which may potentially dilute control. So where control as previously vested with specific investors. Issuing shares may potentially dilute means lessen their influence and voting power within a business. So that's probably a negative thing, and it's a very important point that you should always consider when looking at the theory question. Is that equity is good um, because of a cash flow risk, but the downside is that you could lose control from dilution. The return to the holder is a form of interest for a debt instrument. Of course, for an equity is its dividend and capital growth. That's how the investors get back their money. Flexibility, how flexible? Debt is less flexible because it's restrictive. It puts pressure on management. You have to pay these amounts no matter what. Whereas equity is more flexible, where you basically have to pay the money to investors only when the business is doing well or is capable of being able to pay that amount. Let's focus on short-term financing instruments. Initially, we spoke about how one can raise funding in the money market, But what type of instruments are available in the money market? Overdrafts, key tool. The nice about this is that overdrafts are flexible, but of course they tend to be very expensive. They have high interest rate and are subject to recall, meaning many people don't understand this, that legally a bank can call on an overdraft at any time, right? It's payable on demand. So that's the risk behind overdrafts. But of course, they are flexible in that there's no like defined payment term, but the interest can be quite expensive because of the result. So again, for your working capital needs, this might be a good one. Another one could be commercial paper where the tenure is less than 2 years. Usually it's unsecured promissory notes issued by corporates, right? Usually high rated and used for large short-term funding needs, right? You could have issue commercial paper there. Trade credit, this is good for, as particularly for supplies. I'm thinking about Pick and Pay, Checkers, all these different supplies where um they basically may buy all their stock on credit. Um and that's a good trade credit form of funding to purchase inventory in your business. It's effective for operational liquidity. Another one is factoring and invoice discounting. Like some of the entities that have high concentrations of credit risk, where they sell on credit, you think about your clothing companies or maybe your telecom entities on these 24-month contracts. They may sell their receivables, right, to banks or other financial institutions through factoring. And then there's factoring. This is where you sell the receivables at a discount to improve cash flow as a business. So the factoring involves full credit control transfer. So you sell basically your right to receive those cash flows from those debtors, of course, for a cost, but then you've got this benefit in that you don't have to wait and carry the risk of the receivables. You get your cash up front. Um, that would be called factoring and invoice discounting. Okay, cool. Another form of financing that people forget is leasing. So leasing is actually a form of financing where you can basically obtain an asset, and in exchange for obtaining the right to use that asset, you can literally pay a monthly or a quarterly or a periodic annual amount, and that's you getting an asset for in form of financing. So there are different types of leases, which is finance lease. So sometimes you could especially from a lessor side. You're looking at a lessor side here, where you're providing funding. And when you provide funding via financing lease, you're transferring substantially all the risk and rewards of the asset to the lessee. And in this case, you basically having a net investment in exchange for letting go of an asset for a substantial period of time or transferring that risk. Cool. Then you get an operating lease. So an operating lease, this is where you do not transfer substantial all the risk and loss of ownership. So you keep the asset, but you're renting it usually for shorter periods of time. And then the lease payments, of course, from a lessee are expense, but from a lessor, you could raise it as income, right? But now, although here we're saying finance and operating lease, we know that the new IFRS 16 standard does not have finance operating lease from a lessee's perspective. So if you're a lessee and you're trying to raise funding via a lease, then a finance lease would be where you obtain the asset and all the risk associated with the asset, and you pay a periodic amount. And an operating lease where you don't have the incidental right to ownership, but rather you rent it asset for short periods of time, and then you basically expense in the income statement. So financial innovation is another key tool that underpins sources of financing. So financial engineering has led to creative instruments. So we've talked about derivatives for risk management, options, futures, and swaps. An option is a right to buy or a right to sell an underlying asset at a defined price in the future. Whereas a future is basically an obligation to buy or an obligation to sell an underlying asset in the future. A swap, as we've covered last time, this is where you swap one element of a contract for another. For example, if you're exposed to interest rate risk, you can swap a variable rate for a fixed rate. If you are exposed to currency risk, you can swap one currency risk for another, all right, in order to be neutral. Again, derivatives for risk management purposes. Securitized products, this is where you've got products and they've got underlying assets. So you provide a loan or funding, but it's backed by an asset, meaning that if the person or the counterparty fails to pay you as a financial institution, you can take the assets as collateral and cure using those assets. Right? We talk about mortgage-based securities there. Convertible and preference hybrids, we've spoken about that. And the objectives of this financial is risk management hedging. We've spoken about hedging. Tax and cost efficiencies could be issued, and creating liquidity. Okay, guys, this brings us to the end. Hopefully, this was beneficial to you. On any until we meet again, see you next time. Bye.